Hey folks, welcome to another product review at Finominal. Today we're going to have a look at one of the largest and most successful mutual funds, specifically Fidelity's Contrafund, which has a ticker FCNTX. Now, the fund has a track record of around 40 years and manages an astonishing $120 billion of assets. Now, let's find out what makes this fund so successful. If you look at the fact sheet of FCNTX, it does state that the fund has a bias towards growth stocks and quality stocks. So let's see what the right benchmark would be. Now we're going to use our performance benchmarking tool, which suggests that the S&P 500 Growth Index is the right benchmark. And that kind of overlaps with what the fund manager is stating from a stock selection process. We do see it does have a fairly high R-squared, slightly higher than to that of the S&P 500, and also lower tracking error. Now, more importantly, that the fund has actually outperformed the S&P 500 Growth Index as well as S&P 500 since 2001. Now, let's see actually what the overlap in holdings is between FCNTX and the S&P 500 Growth Index. And we're going to use our securities analyzer, where we're going to use IVW, which is an ETF that is a proxy for the S&P 500 Growth ETF. Going to look at the fund overlap. So here we can see that FCNTX has a portfolio of around 338 stocks, so quite diversified. We can see IVW, which is the S&P 500 Growth Index, has about 243, and there's an overlap of about 100 stocks. Now, percentage-wise, that is an overlap of 46%, which is on the higher side. And if you would quantify that into an active share, you end up with an active share of around 54%, which is lower. Now, that might indicate that, given that the portfolios are relatively similar, that there's been a style shift, because we do see a significant outperformance historically. So intuitively, you would expect large factor exposures. So let's investigate that with our Neue Factors tool. And the first thing that we need to do is we need to select the right benchmark. Otherwise, let's take the S&P 500 Growth Index as a benchmark and have a look at a returns-based regression analysis where we can look at the betas. Now, we do see that the betas were quite volatile during the global financial crisis in 08-09, as expected. Having said that, thereafter the betas were relatively minor. We do see some consistent betas. For example, the beta to low volatility factor is consistently negative. We do see it almost consistently be positive to the momentum factor, versus the beta to the value factor is almost flat, as well as quality factor. So it seems to be a little bit like a pro-momentum, anti-low volatility portfolio with occasionally value and quality characteristics. Now, if you look at a mutual fund, aside from understanding what is driving the return and risk, the next important point is, has it outperformed its benchmark? And for that, we're going to go to the alpha analyzer. And for us, alpha does not mean outperformance. It means the outperformance that we cannot explain via the market or via equity factors. And again, let's select the right index for this exercise. So we do see effectively, just from a headline perspective, the active share that I mentioned earlier, 54%, versus S&P 500 Growth Index, that's on the lower side. We do see overall that FCNTX has outperformed like previously, but if you look at the alphas, we do see slightly different pictures. So alpha is simply, if you take the return, if you subtract what has been contributed from the market, what has been contributed from factors like value, momentum, and so on, and what is left, what is unexplained. Now, interestingly, FCNTX had a fantastic alpha over the first like 6-7 years between 2004 and basically 2010, leaving the 2008 aside. But the consistency in alpha thereafter is well, much more subdued. And as you can see, the 2020, 2022 were not particularly pleasant years. Now, this could just indicate that it's tougher making money or generating alpha today, simply because markets have become more efficient. Given that the factor exposures have been relatively consistent, it could also indicate that the portfolio is simply too diversified. I think there's 338 stocks. And so there's a variety of reasons why you could explain that the alpha generation has become more mixed over time. Now, in case you do like FCNTX from a style perspective, but perhaps don't like the product itself or the fees, one thing we can do is simply say, is there a cheaper version of that? And we can look at the fee reducer. And interestingly, I think there is a fund that has almost the same return, exactly almost the same return, but charges less. Now, I haven't come across this fund before, Elephant Trusts. I think it's a product from State Street, but it does have a track record that also goes back quite far. And as you can see, the trends and performance were almost identical. Now, in case you want a different product, there's plenty of other ones. For example, here, one from State Street, core equity product, which I think also has a track record that goes back quite far. And here we can see almost identical performance again, going back to the 1980s, and yeah, at a much lower cost. So what did we learn about FCNTX? So I think it's a product that has a fantastic long-term track record. We can see that the factor exposures have been relatively consistent across time. Having said that, we can also see that the alpha generation has been much more mixed, which just might indicate that it's more difficult to make money, which unfortunately is a general issue for the fund management industry. And if you still like it, but you want to have something that just charges less, there's plenty of other options. That's it. Hope you learned something. Have a nice day.